Hey traders, this is Blake Morrow with Traders Summit, and with me today I have Jim Welsh from Macro Tides. He's joining the show. Jim, good to see you. And I know we are a day early, aren't we?
We are. In fact, it's Thursday rather than Friday, and but unfortunately, the week is not going to be any shorter. So we're going to still have to go through Friday to get to the weekend. But I'm glad to join you any day of the week.
Thanks, Jim. Well, you know, it's something that we had to do because of scheduling conflicts this week. So I want everybody to know that as you're watching this following the jobs report. We don't have the benefit of actually seeing, how the market is responding to the jobs report, which is going to be tomorrow on July 8th. However, Jim, I want to ask you, do you have any thoughts going into non-farm payroll, and are they going to have an impact on the markets this week?
They are going to have an impact, Blake, because expectations are so high. People are so focused on seeing whether or not the labor market's starting to ease. I think people, because of the decline we've seen in commodity prices, we've seen a narrative develop where, as commodity prices are coming down, that means the economy is slowing maybe more abruptly than previously thought, and maybe that means the Fed won't raise 75 in July and subsequent meeting, blah 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 blah. So I think the look here is for anything that provides support for that narrative. So, job growth is a little less, wage growth a little bit less. I think that feeds that narrative. And I think there's a greater likelihood they're going to get those kinds of numbers that are supportive. At the same time, the caveat has to be is the labor report is, one of the more volatile reports are. The 150 some million people working in this country, 1/10 of 1% of 150 million is 150,000 jobs. So that's why, this number gets so revised going back in time because of those revisions being necessary due to the volatility. But yes, I think the market wants to hear and see something that lends credibility to the idea that the Fed will be able to downshift at some time in the next handful of months.
Yeah, and you've seen this big move in commodities this last week or two as everybody prices in a recession. And I know you're not in the camp that a recession is going to be this year. You think it's going to be 2023, but the commodities market really reflect that it's going to be indeed this year, which doesn't make the market right either, Jim, right?
No, it isn't. I mean, it didn't expect a recession a few months ago, and now here we are. And the debate has gone from whether we're going to have a recession or not have a recession, and now it's like, oh, we're going to have a recession. Now it's is it going to be just a shallow, stretched out recession, or is it going to be a hard landing? The debate has definitely shifted, and the commodity decline, as you noted, kind of has shifted the weight toward, oh my gosh, there's the potential for a hard landing, and what that might imply then for Fed monetary policy.
Got it. Well, that makes a lot of sense. Well, we've seen a bit of a recovery in the equity markets as we head into the jobs report on Friday, which is once again, it is going to be tomorrow. I want to share your updated chart from the S&P. You talked. I remember last week you talked about how important it was for the S&P to hold this 3740 level. We held it, and what are you thinking now?
Well, the expectation, as we discussed last week, Blake, was that the rally from 36.37 to 39.46 was a wave A. We would see a pullback, and as long as we held, as you noted, 37.39, my expectation was that we would then see a wave C that at a minimum would take the S&P above 39.46. Two legs are equal, potentially over 4,000 and closer to 4,048. So in a way, I'm backing into the idea that the market wants to interpret whatever number comes out tomorrow with the report in a positive light, because this pattern implies we're going to be higher at a minimum, as I said, above 39.36 and potentially over 4,000. After that, I think the market's going to have another pullback, and the nature of that pullback will be pretty revealing in terms of, are we going to a lower low? Or from a bigger picture standpoint, Blake, what I'm starting to move toward is that the decline from 4,800 in January to either the low at 36.37, or if we get a subsequent drop towards 3,500, is wave A of a bigger bear market. And that at some point in time, we're going to see a wave B that retraces 50%, 61.8%, or whatever the decline is. So if we go from 4,800 and the S&P bottoms at 3,500, just nice round numbers, 1,300 points, 618 retracement of that is about 8-point rally. So that implies, hey, you bottom at 3,500, you're going to 4,300, and maybe even a touch higher for a B wave, which will then be followed by a C wave decline that takes us to a lower low, below whatever this low is in all likelihood. So that to me, I think is growing in probability. I do think the Fed is going to have a window of time and the markets are going to want to seize on this, that, hey, they won't raise, again, I'm in the camp, they're going to go 75 in July and then downshift in September. Well, as more people latch onto the idea, okay, yeah, we're going to get to 75 over and then the Fed's downshifting. That to me lays the groundwork for this B wave rally. It takes the S&P to, between 4,200 and 4,400. The very short term here is we could get a rally above 39.46, maybe above 4,000, and then another pullback. And if that's a higher low, then that to me would be the launching pad for an extension and for this B wave to occur. So I think we're coming close to a place where we're going to get a last more than 3 or 4 days, and it's going to last more like 1 to 2 months, and that's very common in bear market decline. If you go back to 2008, you'll see, despite that huge decline, there were a number of multi-month rallies within that framework.
All right. Well, that'll be probably very good music to some people's ears. Let's talk about the treasuries and the TLT. How do you feel about treasuries here? Because we've seen, I'm speaking today, rates are moving higher, bonds are moving lower, as you pointed out here in this chart, and it looks like we rejected a pretty big moving average there.
Yeah, that's just one of my moving averages. I think it's probably an 89-day moving average. I like Fibonacci numbers. The perspective I've had is that green area in mid-June is when, okay, I think we're going to get a rally up to 119 in Treasury on TLT and, of course, Treasury bonds. And the reason is that potentially from the high 155 in the upper left corner of this chart, you can see in red 1, 2, 3, 4, 5. And 5 is a question mark because, in other words, I can count 5 down. There's another way where I can make that a wave 3 low, and we're getting a wave 4 bounce to be followed by another leg down. And the other concerning point is if you look at the rally of Blake from 108.12 to 115.16, TLT rallied $7.04, and then from the low of 110.85, an equal rally would have been 117.89, and close it got. And now we've overlapped. So to me, there's the potential that this is an ABC up and it's going to be another drop to a lower low. But from my perspective, I'm looking for an important low, because once the decline from 155 to whatever it is, if it's at 108 or whatever it is, we're going to see a very meaningful rally in TLT that I think retraces 382 to 50% of that decline. So I'm looking for entry points. Now, after going long in mid-June, what I told my subscribers on Tuesday was they should try to sell TLT above 117.75. I thought we'd have a pullback to 113 or so on TLT. What happened is in the overnight trading, the T-bonds actually traded higher on Tuesday morning than they did on Monday and Friday. But by the time TLT opened, only got up to 117.54. So I then also said, on 40% of the position, stop out at 116.10, because I think my bias is that yields are going to be coming down. I want to position for that. At the same time, knowing there is the potential that bond yields might spike up one more time. I'm against that, Blake, because of things like the commodity price decline, the slowing in the economy that's going to, I think, gain some momentum in the coming weeks. And it's kind of like what the heck would cause treasury yields to spike up now? And so I'm in the camp that leans toward that. We're going to see TLT at least get to 119 and change. And I think potentially a 382 retracement is up around 125, 126, 55 down to 108. And that's why I think TLT is going to ultimately rally, and it could potentially rally even more than that. Anything you say, okay, identify what could be an important trading low. And as the rally progresses, you have to, keep your eyes open to be able to make actions of, higher prices, or hey, it's over with. So I think bond yields are going to come down in coming weeks, Blake, and to me, the pattern supports that view.
All right. Well, thanks for the look for the TLT. Let's talk about the euro. I mean, the euro has absolutely gotten clobbered this week. It came out of the gate. The euro broke down. We broke this, this 103.30 level. I mean, are we going to see parity in the euro?
I would say the odds have increased. One of the things, I was bullish on the euro back in May, looking for a rally to 107.5, 108. We got it. As we got near 104, I was saying, hey, I want to be a buyer because I think the dollar's near a high. But, this chart is kind of a teaching example. So it got down to under 104. You saw that bounce from 104 to almost 108. Nice bounce. Then it pulled back to 104. This time it was the second time it was only able to bounce to 106. When something comes down to an important area of support and has a weaker bounce, then you got to be careful, because what that implies is the risk and probability of it going down and taking out that support is obviously higher. If it had bounced to a higher level above 108, for obvious reasons, it's further away from that support. But that higher rally implies that you have more inherent strength in a market. This was showing, we had a nice bounce, we went down, and a pretty paltry bounce that retraced about half of that prior rally. And as always, taking out two prior lows, you have to make sure you got stops not too far away. And I think that that obviously contributed to the velocity of the time. But to me, there's the potential, Blake, that high around 108 was a wave 4 high from going back months and months. So that first drop down to 103.60 was wave 1 of 5. The bounce to 106 was wave 2. And we're in wave 3 of what will be wave 5. And that, by the time all this ends, you'll probably be subpar by some amount.
Okay.
And people are talking about, dollar strength. No, it's euro weakness. It's 57% of the dollar. And what we saw over the weekend was Germany acknowledging, the energy problem that they're facing come winter. Russia, or Gazprom specifically, reduced net gas flows by 60% about a week or so ago. On July 11th, they're going to cut it off entirely due to maintenance. If you want to believe that, I'm sure they'll sell you a bridge somewhere. So the point being is, over the weekend, they came out and said, we may have to regulate, and I'm paraphrasing, access to warm showers, warm water. They're going to have to ration natural gas to consumers and businesses. Well, there's a lot of industry in Germany that depends on nat gas. So I think that over the weekend light bulb, like, holy Moses, this is actually getting really serious. The EU is going into a recession. ECB is not going to be able to hike the way they were talking just a handful of weeks ago. And so that disparity between monetary policy from the ECB and the Fed, all these things I think contributed to this breakdown. And my guess is it's got more to go, and you'll see the euro under par.
All right. Well, here's the dollar index, and you mentioned you were looking for an important high in the dollar index,
Yep.
but it sounds like your tune might change a little bit. That we might have some higher levels to go, since you've got so much euro, integrated into the
weighting. Yeah. I mean, again, what we've seen is the dollar keeps making higher highs, higher lows. The red line is the 5-day exponential. The green line is 13, and you can see consistently holding above it. So, to me, you got to give the benefit of the doubt to the dollar only because of what's going on in Europe and what that means for economic growth and monetary policy over there. So the divergences that were apparent a few weeks ago when the dollar got above or got almost to 106, you can see the RSI in mid-June was lower than it had been back in late April and in May. Well, we're kind of negating, if you will, that potential setup. So to me, until proven otherwise, I think you have to wait for more weakness to show up. And really what that really means is more strength in the euro. So, maybe it doesn't go below par, but we're going to have to see technical signs. It's putting in the bottom.
That makes sense.
Just simple.
Yeah.
It is what it is.
It is, and one of the byproducts with the dollar moving higher is you've got gold really breaking down here. Yep. So, what are your thoughts on gold? If you're a gold bull, is this the time that you want to be buying gold?
I think so, personally. Yeah, I mean, from the high at 2,067 we saw in March, a big sharp decline, then an ABC up into probably late April for wave 2. Under 1,800 to 1,792 for wave 3, and that was like looks like mid-May there. Yes, the rebound was wave 4 to whatever that was, 1866 or 67, something like that, right?
Right.
And so I was looking for a decline that would take us below 1,792. I thought it would hold 1,765. There was a trend line going back a while. Well, obviously. Right. Now looking at this chart, Blake, wave 1 from 2066 dropped to $164. And if you take $164 from 1867, so wave 5 and 1 will be equal, you're down around 1710 to 20-ish, somewhere in there. So I think looking at this pattern from that high of wave 4, you got 1 down, 2 up. Obviously, this decline this week is wave 3 of what I think is wave 5. There'll be a bounce, and then in all likelihood, we'll take out whatever low happens, whether it was yesterday or yet to be seen in the next day or so. And on that subsequent lower low, somewhere between 1,700 and 1,720, I think I'd be a buyer because that completes 5 down, and minimum I would expect to rally back towards 1,850.
Well, let's hope we get that, Jim, because I know a lot of people that trade the gold market are very, how should I say, a little bummed out that they're just not getting the they're getting this downside and they're not getting any upside. But I think a lot of it has to do with the dollar, right?
Oh, absolutely. But at the same time, I think we didn't show the chart of gold, but I've been writing about it in my letter. I kept looking. Now I think we're going below 1,792. Hold 1,765. Obviously, the magnitude of the decline this week's like, okay, that's wave 3 of 5. We got more to go. And then the equality of wave 1. And so, to me, prior to what happened with the euro and dollar strength, the chart of the gold looked like you need to go down below 1,792 to complete something. That's what I was looking for. The decline has just gone a little bit more than I expected. It doesn't, from my perspective, doesn't change the big picture. That we're completing, in the process of completing 5 down from 2066 in the March high. And you're going to get a rebound of some magnitude. And at a minimum, I would expect, as a wave 4 a lesser degree, which is 1850 to 1870. So in the low 1700s, yeah, that's a good trade. So anyway, that's my take. And again, this could all tie in with, as people shift toward expecting the Fed to maybe downshift, especially as we get closer to July, the July meeting, it's like, okay, they're going to go 75. And we'll see in the speeches in the next week or two. Do any of the governors come out and say, that 75 isn't on the table or may not be the right, in other words, cast out, because they've been uniform and unanimous in terms of we need to get to neutral. Neutral's at 250, according to Powell. 75 basis gets you to 2.25, 2.5. And they want to do it expeditiously. Do it in July. Then you're in the zip code of neutral. then you have the option and flexibility to downshift from 75 to either 50 or potentially 25. I think 50. And that expectation is why I think we could see a pretty good rally in equities going into that September, October time period, as people start to say, hey, they're not going 75. They might go only 25 in September. You know, that's what moves markets. And, you know, the bond yields coming down, that supports that. Finishing 5 down and then having a pretty good rally because the Fed is going to back off. Well, that supports that analysis as well. So to me, some of the technical patterns in various markets are aligning with the idea that, yeah, the Fed is going to go 75, but that gives them the optionality then to down at the September meeting. And that's going to be obvious. I think that'll, the data and Fed speeches are going to tell us, you know, they'll start saying, well, we're much closer to neutral than we were, you know, 5 months ago. What does that really mean? That means I don't think we need to raise rates as aggressively in coming meetings.
All right. Well, let's hope that that's the case, Jim, and we'll see especially following this week's jobs report. Let's see how important the market finds the NFP this week. So, Jim, I want to thank you for
next week when we do our call. I don't have on my face or pie on my face, right?
All right, Jim. Hey, remember, guys and gals, if you like what Jim does here, make sure you give him a thumbs up. You know, there's a link down below in the description of this video. They'll take you directly to Macro Tides, but that's where you're going to find Jim. Jim, thanks for spending your time with us, and we'll have a great week of trading.
Yeah, all right. Thank you so much, Blake. Have a good one.
You too. Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.